Now, our first question that came in via email was Jonathan. This is related to the radioactive trading techniques, the limited risk Mary put, and selling a call against it, but then managing that call if the stock moves down in price and you have maybe hopefully a small profit on the position. It's also going to relate to anyone who's doing covered calls perhaps as well. So when I'm in a married put position, income method number 1 in the blueprint is just selling a call. And then income method number 2 walks through the guidelines of properly rolling that call and adjusting that call if the stock moves above the strike. And this is where Jonathan finds himself. He says, when you're using income method number 2, are there profit targets you are looking for when buying back your covered call in a married put type position? Well, the first answer for me, Jonathan, is not exactly. Now, in general, when I do an income method number 1 position, I'm hoping to go to expiration as close to possible. If it starts to move up above the strike price, naturally, I will look to roll it up and use income method number 2 as you did. Roll up the short call as I would maybe in a covered call or maybe a standard collar position. But in general, if I'm shorter term, and let's get to your second comment here on this, but when I'm shorter term, I'm trying to hold it as close to expiration as possible to maximize the profit. So you said if stock ABC is at 100, now you have the possibility of selling a covered call at 1 week out, 2 weeks out, 3 weeks, 4 weeks or longer. If the stock takes a large drop, the covered calls with the nearest expiration would lose the most value. That's right. They're going to have the lower time value initially. They're going to decay in your favor faster. Now, are you considering taking profits at different amount of loss based on the expiration date? At shorter term, I'm trying to maximize profits, meaning if I was in a married put and I sold a 1 week out, a 2 week out, likely even a 3 week out, even if the stock's fallen, I'm going to hold the call as close to the expiration date as possible to try to get 100% profit from that smaller premium. I don't look to close it at 80%. I don't look to close it at 70%. In those situations, I'm just going to wait when I'm shorter term, get 100% profit, and then I'll evaluate what I want to do with the position after that call is expired. That is my approach. Ernie might tend to buy it back sooner using probably an 80% trigger. And that's if he's anywhere, 1 week, 2 weeks, 3 weeks, 4 weeks, or even maybe 2 months out in time. Now, you expanded on this, Jonathan. You said if 1 week take a profit at 80% loss, 2 weeks I'd still be at 80, 4 weeks I'd still be at 80, 8 weeks at 30. No, I still don't want to see much higher profit on that. I don't think I want to buy it back if I'm 2 months out, 3 months out in time, if I've only got a 30% profit on the call. I'm going to want that to be higher, and I will wait on that to get the premium. Okay, now the reason you're asking, you have a position that moved up on you quite a bit. So you kept rolling the calls until I was many months out in time. Now the stock's fallen, but I'm only up 25 to 30% on my short call. You were considering buying back that short call for a small profit or break even, and then going back and selling near-term short call to take advantage of the time decay. My thoughts on this are, run the math. You've rolled up your position a couple times. You've rolled up your short call. You've maybe added to your cost basis, but it sounds like you were rolling for a credit to go further out in time. So each time you rolled, it sounds like you were getting a credit on the position to lower the cost basis correctly and effectively. Now, you only have a 30% gain on your short call that's maybe 8 weeks out in time. Run the math. What I mean by that is over the course of the next 8 weeks, what is the remainder of that 70% premium? And if you buy it back now for break even or only 20 or 25% gain, or let's say even a 30% gain, leaving that other 70% you originally sold on the table, what is remaining that you can get in the shorter term? It's almost like comparing right cycles in a calendar spread. Are you going to make up more than that 70% if you're writing a lower strike now that the stock has fallen week by week by week? The answer is probably yes, but if you compare it to 2 weeks out, you might not be getting that. You might actually be better off waiting for more or closer to all of that missing 70% profit you had on the call itself. I don't know the drop specifically, but let's take a look at an example that I sort of just put together after I received your email, and we'll take a look at it on the Power Options suite of tools. Let me change my screen over here. All right, fantastic. So, of course, what we're looking at here is just your basic 14-day free trial account. Those of you that are just getting started, you want to make sure that you take advantage of the 4 steps that are listed here. on your trial account, that free quick start guide. You can go through some of the various flash tutorials to help you see some of the tools in action. We do, of course, have a variety of archive webinars and live webinars, and, of course, the coaching session is important as well. Want to make sure that you schedule one of those. Any trial member or subscriber can schedule a coaching session at any time. All right, so based on Jonathan's brief numbers that he put in, we're going to go over to my portfolio. I'm going to go to the main portfolio tools, and I put in a position with Yum Brands. Now, I simulated doing it today. It's not the real prices. I should have used a different date. But Yum Brands is at currently $84.90. So I'm going to say a few weeks ago I bought the stock at 100. The same time I bought a December 100 strike put for $14.50. Maybe I bought it a little bit lower. Maybe I rolled the put up since I originally got in. And I'm holding now an October 100 call for a premium of $305. It's currently at $237, so I only have 22.3% gain, close to what you're talking about with your call that's out to October. Now, as I mentioned, I didn't even look at the profit and loss chart when I simulated this position, Jonathan, but let's take a look together. Okay, so it's not that great. Max risk percent return. Okay, the premium was too low. But let's say I've been rolling up this position and I added to my cost basis, so right now I'm not in a good position. Maybe we should change some of these numbers, make it look a little bit better. This is a fake position, so let's drop this down to 1150. Still be about 11% risk or 10% risk. Did I get profit here? No. I'll drop it down to 8. Sorry about that. Let's see if we get a profit now. Yay, okay, so a small profit on this position. Now the stock's way down here at 84. As we saw, I only have about a 22.3% gain on the short call. I buy back for a price of around 240, I think it was 250. So we made 68 cents on it roughly. I do want to see more of that. Now, this isn't a great position. I should have worked better numbers on this. But one of the reasons why I'm saying I want more of it is that even though you did this, Jonathan, in a defensive move, as the stock was moving up, you continued to roll your call up and out in time, and now you're in a position where the stock changed direction and came down. So we've got this deep in the money call, but when I roll the call, when I make an adjustment each time, I look at the profit and loss chart, and I wouldn't have sold this position. I wouldn't have entered this income method number 2. I wouldn't have rolled to this call if I was not completely content with the SIGA model in all of the situations. Now, what do I mean by that? Meaning the outcomes of this position. If I wasn't happy with the return, if the stock was trading right at the strike price at or near that short-term call expiration date, if I wasn't happy with what this would look like if the stock fell 10%, or if I wasn't happy with what the upside looked like if the stock moved up 10%, I wouldn't have gone into this call. We call it the catastrophe report. I would have run that first, and if I didn't like these numbers, which I can tell I wouldn't have for this fake position, Jonathan, I never would have entered this. I never would have rolled to this income method number 2. I might have bought my call back and just let the stock go and then look for another opportunity. Well, that's all hindsight 2020. It doesn't help you now. What I was referring to on the slide earlier with my comment on the slide is, what am I missing on this call? Let's take a look. I simulated having to roll out, I probably had a May, and then I had to roll it to a June, and then to a July, and then the stock crater. Let's say it went up to 115, and now it came back down to 85. So I'm all the way out to October, and that price right now to buy it back is, going to be about 240 or so, 245 at midpoint. Okay, so let's call it 245. I'm only made 60 cents in profit. Okay, so we buy this back for 245. So I've only made 60 cents, and I'm leaving that 245 there if I buy it back, right? That's the time value I'd still have left to decay in my favor. Only got 60 cents in right now, 245 is left. Now the stock is around 85. I still want to be maybe out of the money, so let's go shorter term. And let's go maybe 14 days. And let's take a look at the 90. And it's at 34 cents. Well, I'm sorry, let's call it 50. It's a wide bid-ask spread there of about 40 cents. Let's call it 50 cents. Okay. So the out of the money 90 calls 50. Why am I not doing the 85? Well, if the stock recovers and moves back up, yeah, $2, $3 to buy it back. Didn't really get a lot there. Also, if I do the 87.50, it's about $1.20. I might be a little bit better in that case. But we're going to stay somewhere out of the money. Going 2 weeks out in time, we're only getting 50 cents. Now, we go back down to October, which is 154 days away. So in this case, what does the math tell me? Math tells me this works. I get 50 cents for 14 days. By buying it back, I'm sorry, it's 14 days, not decimal point 14 days. So we get 50 cents for 14 days. If I assume I get close to that every 14 days over the next 154 days, we're just going to call it 10 right cycles, right? I could write that about 10 times, staying out of the money, maybe getting 50 cents. And that would more than double the 245 I'm taking off the table right now from the original call that I have. But in my position, there's a big catch-22. And the big catch-22 on this position that we're looking at is that I absolutely do not want to buy that call back right now for 245 at the 100 strike and sell this 90 call for 50 cents when I'm holding the 100 put. So I'm going to add $2 to my cost basis immediately, and now I'm selling a call 10 points below where my put is. And that's a no-no. All right, that's going to get me into a high risk on the upside if the stock does recover. So let's buy it back and do it. Let's just show it. So first things first, we're going to buy this back, and we're going to use our 245. And then we're going to sell to open this near-term one at 50. And what's that going to do to my position? Well, it's going to take my cost basis up to about 107.80 or so. I'm sorry, about 107.45. But it's probably going to increase the risk, not to the downside, but to the upside. So what I have to do in this scenario, if you're looking to do this, I don't know where your put is, Jonathan, but you're going to have to address this put before making a move on the short call if this is your decision to do it, if the math works out for you long term, and understanding that in that first cycle, if you buy back your 2-month out, 3-month out call, and you roll into shorter term, you're going to be increasing the cost basis because you're taking time value back into the account. You're paying back more than you're getting in right now. So shorter term, you're probably going to be seeing a negative return with the plan that you're trying to sell month by month or every 2 weeks or so to get back to a profitable position. All right, that's what you'd be looking for in this case. So again, if I'm already short term, if I'm a month or less out in time, I'm always trying to get 100% profit on this call if it's below the short strike price. I'm not going to worry about buying it back at 80% rule. Sometimes that's used in a covered call. I don't use it in the radioactive trading technique. If I'm 1, 2, or 3 weeks out, even 4 weeks out, I want to try to get 100% of that premium because it matched my catastrophe report. If I'm 2 weeks out in time, I'm sorry, if I'm a month out in time, if I'm 2 months out in time, you mentioned 8 weeks at 30%. I'm still looking for more. I probably want at least 50, 60, maybe 70% if possible, even if the stock has fallen, because originally I would have wrote that call because I was comfortable with the catastrophe report of holding it for 3 or 4 months. And if the stock's trading at the strike price and I get the max return, I'm great. I would have agreed that that's my goals for the position. If it goes up 10%, I was comfortable with the result. If it goes down 10%. I don't like this because personally, I'm probably not comfortable if the stock gains back another 10% or it drops another 10% or is trading right at the short-term strike price. This doesn't look like an appealing position to me personally, even though your game plan is to keep trading longer to try to get this peak up if the stock recovers or as things go on or you're able to get more premium. Another thing you may have to evaluate in this case is the expectation, and this is important. Let me clear the other two out. Now we know, remember, I'm missing 245. If I bought this back, it's 245, so I've only made 60 cents. Between now and October, if the stock stays at the same price of 84.90, what I also want to know is what is the trade-off of the 245 compared to how much I'm going to lose on the put. Okay, so how would I do that? Down here, I'll say, look, what if the stock stays to 84.90 all the way to October expiration? What can I expect to see? So right now, well, we'll look at the current prices instead. So we know that our call would go to 0, and our put would be right at about $16. Okay, and that makes a lot of sense. It's pretty much close right to intrinsic value at that point. About $1 more with 2 months to go. But right now, let's take a look at where that put is right now. Current prices, December. There we go. It's about 1930 to 2075. So here's another dilemma you're going to be facing. 2075. Okay, so let's just say it's at 1980 is the current price for this put. And we'd get our 245 decay back between now and October. That's a little bit longer than what you were saying, but this is still what you'd want to look at. This is going to be a drop of roughly $3.82 in time value on the put if I hold it all the way to October expiration, isn't it? We'll drop from 1980, where we are now, roughly at midpoint, down, let's just call it 16. So it'd be $3.80 drop. And then I'm gaining 245. So here's another dilemma in my situation where, I'll be honest with you, Jonathan, this would make sense for me potentially to buy to close this call back and try to start selling maybe shorter term. Because if I do hold it as I originally expected, the time value I'm getting from the short call that remains right now is not greater than the time value I'm expected to lose on the long put option, which is, into my cost basis. That's my purchase. So that's another thing you might want to look at, the benefits of how much more time are you getting on your short call if it goes to that expiration. You had mentioned 8 weeks out, so it's probably not as far out to October. But over the course of the next 8 weeks, how much more time premium are you expecting in versus how much do you expect you might lose on the put in time value? If the call is higher, if the time value you expect to gain, if the stock, you hold it for the next 8 weeks and the time value goes to 0, if that's higher than what you're expecting to lose on the put, I think it's perfectly fine to stay in it. If it's not, then you might want to consider buying it back now, maybe trying to sell shorter term to get a better annualized return with the shorter term positions. But again, you're not going to like the view that you see on the profit and loss chart at first because you're likely going to increase your cost basis when you do that. Okay? But to answer the one part of your question again, just to reiterate, if I've sold 1 week out, 2 week out, 3 weeks out, whether it's a income method number 1 in the married put, an income method number 6 in the married put, or even a 5, I'm trying to hold it as close to expiration as possible to get near 100% premium profit. I don't really follow the 80% rule so often in the married put structure. Now, if I'm 2 months out in time or 45 days or maybe even 4 weeks out in time, I might use the 80% rule, but I'm not going to use it on a weekly because already I was only probably receiving 40 or 50 cents. I want to get all of that 40 or 50 cents if possible. That's what my goal is in that situation. Frank has a simple question. If I have a married put, why is it a bad idea to sell a naked put against the position? Well, because it increases the risk, okay? We'll use Yum Brands again. Here's the one with the actual price, $84.90, buying the December 90 strike for about an 8% risk. Okay, so let's go to the profit and loss chart. What have I decided to do with this position, Frank? If I entered this position on Yum Brands, I've decided to allocate $9,802, $9,000 or so, to this position, $9,800. I'm taking a risk of 8.2%, very manageable for December, which again we saw was 214 days out in time? 254, I'm sorry, 254 days out in time. Okay. Now, I just cleared out a married put position in my portfolio today. Got rid of the Yandex position. Couldn't sell it because of the wide bid-ask spread. It hit expiration today, so I just exercised the put. The stock was down 8%. We got out for a 1.7% return. It was a bulletproof position. So I have free capital. Now I'm going to enter a trade. Now, maybe based on my allocation, Frank, that we talk about in the blueprint, maybe I'm considering doing 200 shares of this, okay? And so maybe I decide, you know what? Instead of doing 200 shares, let me do 100 shares of this position. It came up in the search. And I'm going to go out of the money because I am bullish on this stock. And let's just go out 2 weeks. I'm going to sell a 80 put. I said 80 put for about $1.10. Okay, so I'm bullish on the position. That's why I'm in the married put. Why not just sell a put now, as you mentioned, and go this way? All right, so now I've got to cover the price of the stock, 96.72. And in this case, wouldn't have it do with that case. But now what happens? The maximum risk goes up to 89.7%. What if I'm wrong? Before I just had a risk of 8%, and if the stock fell 4 or 5% in the first 20 days, I'm only going to be down probably 3 or 4%, nowhere near that full 8%. In this case, it's a little bit different. I run the risk of losing on the naked put and at the same time changing up the break-even slightly. It gives me a lower break-even. I'm sorry, that's why I was looking at the wrong thing. It did give me a lower break-even in this first 14-day cycle, but I've got a much higher risk. This is not following in the pattern. Now, some investors say, well, so just do a bull put spread, and in that case, now you'll only add a little bit to the risk. Okay, but you're still going to add 5 or 6 points to the risk. I wanted to control it to 8% if I was wrong, if the stock didn't do what I expected. Okay, so I do a bull put now, and the risk goes up to 12.5%. That's not what I want. Okay, especially in a volatile market. I want to keep the risk to single digits. I want to be bullish on the structure. Even if I'm bullish on the structure, you say, hey, naked put's a great idea. Well, that might require more capital, depending on what structure you use. Normally, your broker would say that the long put would cover that, so you wouldn't have anything to worry about. But again, even with just doing that, you're doubling the risk, because the long put can either do what? It can only cover the long stock or the naked put. It can't cover both. And then you try to hedge it by doing a bull put. Well, that's going to increase the margin requirement and increase the risk, because now you can lose on the bull put and the married put as well. That's why we don't recommend doing cash secured naked put in a married put structure, because it doesn't give you the risk we want. I can't imagine what my portfolio would have looked like had the positions that I opened up at the end of December, beginning of January, Fabrinet and then later KHC, and also Yandex position and On Semiconductors were there too. If I had opened those as naked puts and then February 25th, 26th, and 27th hit, wow, I'd be in a lot of pain right now. So I'm not. I had a bulletproof position, and I had another position that only had a 5% risk and another position that only had a 7% risk, not 12, 15, or 87% because of the extra risk on the naked put. Now, I know that's if the stock goes to zero, but the losses that can take in a volatile market, losing on the naked put position, will greatly tackle and hurt this as well. Okay? That's why we do. That's why it's not one of the 12 different income methods, and that's why we don't show it that way.